my name is Jerry Guger, Head of Content Strategy at Manning Napier, focused on bringing you the unique views and perspectives of our firm. And I'm excited to be joined here today by Beth Mallette, Managing Director of the Capital Goods Group at Manning Napier. Beth has been with us for 16 years, first starting in the real estate group before eventually becoming a portfolio manager on our real estate strategy, and then shifting gears to focus on all things commodities and cyclicals, including on the energy sector, the materials sector, industrials, and more. And with everything going on today and so far this year regarding inflation, commodity prices, Beth, it's great having you here today.
Yeah, great to be here. I'm really happy to be a part of this. Certainly very uncertain and volatile times. I hope to provide some sort of perspective on that as we go through the next hour or so.
Yeah, absolutely. So before we get going, I know that we do have a number of listeners who are new to us and new to our way of viewing the world. So briefly, and by way of introduction, for those unaware, Manning Napier is an investment manager headquartered in Rochester, New York, managing just under 20 billion in portfolios, ranging from all equities to all fixed income to broad multi-asset class, as well as to more niche specialized strategies. Our traditional, fundamentally driven bottom-up portfolios date back nearly 50 years, supported by disciplined processes, strategies, and risk frameworks, some of which you'll hear about today. And with that, our agenda today is as follows. First, we're going to briefly provide an update to our outlook, one of which I know we discussed with Ibrahim in January and provided an update in April. We know even more has happened. We went from a correction to a bear market, and now where we are today. We're going to provide an updated view on what we see in the economy and financial markets and how we're thinking about the final 6 months of the year. After that, we're going to briefly preview performance, and we're happy to field any questions if you have them. And then finally, what'll probably be my favorite section today, we're going to dive into some of your specific areas of expertise, Beth, on energy, among other topics. And at that point, of course, we'll be willing to field your questions as well. We will also leave time at the end for Q&A. And finally, before we get started, as always, we will not be walking through our views on each and every sector and asset class on this call, but instead we're looking to share our perspective on what we see driving markets today, what our outlook is around them, and hopefully share some insights along the way. And so with that, Beth, I'll turn it over to you. I think it's time for me to mute myself and for you to unmute. And when I think about the second quarter, I think one of the key questions, or maybe if not the key question, was everything that's been going on with interest rates and what the Federal Reserve has been doing to play a bit of catch up.
Yeah, sure. I think we're going to spend a fair amount of time.
1 second. There we go.
Yeah, I think we're going to spend a fair bit of time today, talking about where we are in the economic cycle, where we think we're going, and the Fed's role in that. And just starting off here, what we want to highlight is how late we are in terms of the rate hiking cycle and how far behind the curve the Fed really is here. This chart here is it's just showing several various economic factors and where they have been at the start of various historical rate hiking cycles. So where you can see the darker the green, it's sort of the hotter the factor, the more inflationary it is, whether it be price growth or wage growth, very low unemployment, et cetera. So, the Fed here is later than they pretty much ever have been to sort of taking away the proverbial, punch bowl at the party. And so they're in a really tough position. In effect, they're trying to thread a needle. They're trying to snuff out inflation, with rate hikes while trying not to hike too much, too fast in order to prevent a recession. So, to us, the economy is looking increasingly late cycle. The risks to economic growth have continued to build to a point where we're increasingly concerned that a recession is becoming the base case. And the Fed is in a difficult position, and the risk of policy error here is high in our view.
One of the best parts about this slide is it covers so many things. And you mentioned the phrases such as the Fed playing catch up, recession, so many key parts of our overview. But before we jump too far ahead, Let's unpack that a little bit. We have updated the data this quarter to show exactly what's going on in inflation over the past 3 months. And no surprise, it's continued to stay elevated.
Yeah, absolutely. It's coming kind of at us from all angles. We have labor shortages persisting. There are a lot of supply chain challenges that while they're starting to unwind a little bit, we are, still dealing with some of those. And we also have, supply constraints, in various commodity areas, oil, gas, food, other commodities as well. So, I think, like I mentioned, some of the supply chain stuff is starting to resolve itself. Some of the lockdowns that we've seen in China, with respect to COVID are unwinding. And so some of that, I think, is, probably going to ultimately be fairly transitory, although we've been talking about transitory now for a long time. And it really isn't proving to be the case. But there's other areas of the inflation picture that are remaining quite sticky. Some things that are more structural in nature. We'll talk about labor in a few slides, I think. But also some of the supply constraints that we're seeing in some of the commodity areas have been more structural in nature. So we don't really think that we're in a 1970s type of inflation environment yet. We are questioning whether or not we're starting to see a regime change here. We've been in a period of very low inflation for a very long time. And when we take a longer term view, we think that there are risks that regime change may be forming. I think should the Fed, and their rate hikes tip us into a recession, we also don't know really the strength of their toolkit. Typically when they've, gotten us into, we've gotten into a recession in the past, they've had that Fed put option where they have, been able to ease and to lower rates to deal with that. And we don't know if that's going to be really a viable option this time around without reigniting inflation. And so their hands are a little bit tied. Like I mentioned before, the risk of a policy error here is quite high in our view.
Let's unpack that comment. I know you had made a few remarks about the transitory aspects of inflation, and we showed supply chain pressures, which for reasons that you alluded to, such as in China and their continued battle with COVID over there, they've not fully abated yet. But the structural stuff that you're trying to talk about, and you mentioned the labor market specifically, can you explain why we look to wage growth as one of the key indicators for the structural aspects of inflation?
Yeah, sure. This is probably the area that we see the most concern on when it comes to trying to get inflation under control. You can see here wage growth is and has been really accelerating, particularly for the lower earning cohort, within the labor force. And the thing that's tough is wage growth is hard to slow once it gets started. And that's why it's a key indicator for looking for structural changes and inflationary shifts. Wage growth, it creates a self-reinforcing sort of dynamic as rising wages, really lead to growing spending power and demand. And this creates a lot of goods and services inflation. And that's what is referred to sort of as the wage price spiral, where, wages tend not to come down. And so it gets difficult to fight this when it gets, when you're seeing what we're seeing in the labor, market. There is the potential for the retrenchment in monetary supply that we're seeing could help, with, the liquidity dynamics that could help, kind of cool inflation. But it is challenging in our view.
Yeah, it is when I see this visual, and I know we had shown this before and we've updated it, the spike down has been even more pronounced thus far this year. It just remains remarkable to me how much money was poured into the system over the past couple of years. We talk about inflation. Where did inflation come from? Well, I can tell you how it started. This chart's pretty unmistakable.
Yeah, I mean, absolutely. The economic response to COVID was just definitely the spark behind the inflation we're seeing. You just can't put that amount of liquidity into the system without there being repercussions. So it really shouldn't be that much of a surprise. I think some of what has been a surprise is how, sticky some of the things have really, have really been, and how long we've had to continue to deal with this. That money supply growth is sharply reversing. That really is pulling out a leg from under the stool, which is, has been supporting the financial markets. And so that's what you're seeing at play. Now at a minimum, the tailwind from stimulus is gone. And we don't have that, but it's heading to, becoming an outright headwind markets going forward, just given the inflationary spiral that it's created.
Yeah, absolutely. And I think many people are out there wondering, what are the repercussions of all of this spending going to be? And as you had said, perhaps it's on something like the Fed put in their capacity to deal with a potential downturn.
Yeah.
It is not as if consumers and businesses, although in this case, we're specifically speaking to business owners, are living under a rock. In this case, this is a new visual. And just to briefly explain what those are looking at, this is a survey, what we call soft data, not hard data, but surveying how people are feeling, a sentiment indicator effectively of where people believe the economy, in this case, business owners, will be 6 months ahead of time. And you can see the light green line being the economy will be better 6 months from now. The dark green line being the economy will be worse. It's a bit squiggly at the top, so we distilled them out into the bottom to show the difference between the two. And when you see the kind of sharp turn lower in sentiment, with business owners feeling a lot less confident about the future, that hasn't always been the greatest indicator in the world.
Yeah, we have seen a quick, sharp downturn in sentiment. It can be a decent indicator, pointing to an economic slowdown, emerging. Last year, businesses were feeling really good and conditions were strong, and that's quickly reversed course. I'd say in addition to business sentiment, consumer confidence has also fallen really quickly. Consumer expectations for incomes and business and labor conditions all fell significantly. For June, it's at the lowest level we've seen in almost a decade. And we are starting to see, the beginnings of some signs of demand destruction in certain areas. We're beginning to see inventories, really starting to build in several areas of the economy as well, which are also good indicators of slowdown coming.
And that phrase demand destruction, specifically referring to that combination of maybe inflation, maybe a little sentiment, all of that, meaning
just the shift in consumer and business, behavior that it tends to happen, as prices and inflation really starts to hit the wallet, and, the decisions, just come from there. We're going to drive less, we're going to travel less, we're going to fly less, we're going to, wait to add capacity in our business, whatever it may be.
I believe there's a phrase, one person's spending is another person's revenue.
There you go.
All right, so let's change gears a little bit now from the economic fundamentals and maybe that sentiment story that sits in the middle to financial markets themselves. And in this case, we continue to believe fixed income remains the key story. And thus far this year, it's been the rise in interest rates.
Yep, and we're showing here, just the spike that we've seen in real yields. Real yields, just nominal, interest rates with the effects of inflation removed. And high inflation has certainly led to a rapid increase in rate hike expectations over the next couple of years. And that has definitely pressured the performance in the fixed income markets in the short term, and has challenged the downside protections that bonds, typically would be providing in a portfolio. And so it's been a very challenging environment because, obviously equity markets have been weak, but we've seen that pressure in the bond market as well.
Yeah, and in this case, we're specifically showing real rates to distill out that inflation component. Of course, you combine real rates with inflation to get actual nominal rates, and then you could stack on top of that credit spreads.
Yep. So, obviously not just government rates starting to move, but we're starting to see credit spreads widen on the margin, and higher spreads are typically an indicator of stress in the economy. So something we're watching. We've seen a spike in particularly in high yield spreads, which isn't surprising. Basically junk bonds, where investors are flocking to quality on growing recession worries. What we're seeing here, it's not pointing to an imminent recession, but definitely something that we're watching.
Yeah, absolutely. And then there's also the component of, as rates rise, real, nominal, whichever, and as spreads widen, all of that amounts to just a rising of interest rates. And as we know, as interest rates rise, prices fall. And that can make for a difficult investing backdrop for bond investors. Yeah,
it can for sure in the short term. And we just want to kind of focus on a little bit of a bigger picture here when it comes to fixed income markets. It's worth highlighting that transition to higher rates. It's painful in the short term, on bond performance, but it does get us to a more attractive environment for the bond market over the long run. This chart here is just showing that high correlation between starting yields and fixed income returns over the long term. So for example, like an increase in yields in one given year is going to pressure returns for that single year, but it also leads to, higher returns in subsequent years. So over a multi-year period, yield is the dominant driver of returns. So as yields move up, this is a good thing, for longer term, bond performance, despite the near term pain.
Which, as I alluded to in my opening remarks as well, we remain focused on long-term goals and objectives, and that's for both every name that we buy in our strategies in our portfolio, single security, stock investments, but also on the bond market side as well.
Absolutely.
All right, so let's talk about the stock market. Let's talk about equities and what we're seeing there. We are in a bear market again, down 20%. I think a lot of the advisors, many of which we've had partnerships with going back a number of years now, might be expecting us in a down equity market to start to be leaning into the wind and adding a little bit. We're going to get to exactly why that might not be the case, but part of that story, I believe, is valuation.
Yeah, absolutely. It has been a tough year for equities, and I want to highlight the fact that we are doing a lot of homework preparing, but we don't, totally view the valuations as, cheap by any means. Any way you slice it, whether it's a price to earnings, a price to sales, price to cash flow, price to book, all these metrics here, valuations are no way cheap versus historical, ranges. Maybe outside the US, valuations are a little bit more palatable, but equity valuations have been a headwind, and we view them as maybe a little less of a headwind now, but not signaling, massive opportunities to us yet at this point.
Yeah, I mean, clearly, and as you had said, I mean, we're looking at accrual accounting, cash accounting, we're looking at balance sheet metrics here to try to distill out where the valuation regimes are. And in each case, we're either at median or well above median, at least within the US. But you alluded to this before, abroad is certainly cheaper on a valuation basis. But part of the reason for that is the types of stories, well, yes, but the types of businesses and opportunities that are abroad there.
Yeah, that has been, just this slide here is just emphasizing the profitability domestically that, companies have put up. Corporate profitability is up. It's at very high levels. And that's been one of the key drivers for that, valuation, run up that we've seen coming out of COVID. Companies were really, honestly, very adept at managing and navigating COVID. At this point, we have had several quarters that companies have been dealing with higher costs and inflation. And, there is a risk that that's starting to stack up, and the ability to push that cost inflation through in terms of their pricing is something we're looking at for each and every company that we own in the portfolio, because it may start to impact that profitability story.
Yeah, absolutely. I mean, it's been a multi-decade trend where is profit margins rise, earnings rise, and it provides so much support for markets. And it's certainly a risk or a question of how long that could sustain. So let's tie it all together, Beth. And in this case, we've updated this visual from the beginning of the year, which, as you can see here in the new black circles at the top, this is where we were as of the start of this year. And this is where we are now at the end of the second quarter after the drawdown that we've witnessed in the equity market. And yes, there's been some impact on the 3-year performance numbers and the 5-year as well to a degree. But over the longer run, it still has been quite a run in U.S. equities.
Yeah, absolutely. And, just tying back to what we said about valuations, we've seen the valuations come down. We think it's still too early to buy the dip because we don't have a recession priced into securities yet in our view. And, the earnings estimates for the companies have not yet come down. So company guidance hasn't come down, and consensus estimates for earnings have not yet come down. And so we think that as those, estimates, adjust to this environment, that's going to further weigh on stocks. It's our view that the economic outlook, we're still pretty cautious here. And we want to have dry powder, available. So we're underweight equities. We've intentionally lowered our exposure to equities. So we have, the capability to take advantage of opportunities as they start to really emerge, as we start to move into that next phase, which is, we think, going to be the sort of earnings part of the risk, downturn.
Yep. Yeah, absolutely. And just to make sure, for a point of clarification, we are staying patient right now with regards to risk in general.
Yes, absolutely. We're focused on, quality, which is typical for us. And focused on, where we can be defensive, utilizing tools like gold. We'll talk about that a little more later, but gold, cash where we can, and just staying prepared.
So considering not just the equity side, but the bond market together, although rates have moved up and it is starting to provide more attractive yield opportunities for investors in general, the high valuation environment in equities, the relatively low yield environment in fixed income does amount to still what is a fairly cautious intermediate term outlook.
Yeah, I mean, we view the forward environment when it comes to returns as potentially, more challenged, perhaps over a longer time frame. And in our view, that is the type of environment where active management really shines. Being in the type of environment where we had, sort of a buy and hold, up market for so long, it just, that isn't necessarily the environment where active management shines as strongly as when we get into these volatile, choppy times, where we are doing the bottoms up, portfolio construction process that we bring, that allows us to take advantage of areas, businesses with strong, growth potential that tend to outperform across cycles. And we're seeing, potential opportunities to start adding to some of those, buying some of those. We still like areas like gaming, cloud computing, payment processors, these kinds of areas where we see this sort of long-term secular support for them. And that's what active management, the kind of portfolio construction that can bring you.
Yeah. And just to put a bow on it, I do believe, and tell me how you view this as well, that not just active management broadly, but active management with a lot of different tools at our disposal. You discussed a number of different themes and different areas we're invested in, but our ability to make decisions based on individual companies, style, sector, size, location, those are the types of tools that you're going to want to have at your disposal going forward.
Yeah, absolutely.
All right, so let's turn our attention now to the performance portion of the proceedings. And as we alluded to a number of times, it has been a difficult start to the year. It was a difficult second quarter as well. What does jump out to me specifically? A couple of things. One, as challenging as 2022 has been, over the 3 and 5 year numbers, capturing a little bit of that pre-pandemic run and just how well markets recovered and how swiftly they did, still a significant amount of positive return generated by equity markets, and especially on the 5 year as well. But the other one more interesting to me is the style shift that we're seeing. And it's been the first time in quite a long time that we're seeing value lead, and especially to the extent that it has, not just in the second quarter, but year to date as well. Looking at the broader intermediate 3 and 5 year numbers that we know are so popular, you can still see, however, the running growth, how substantial that was, has built up such a significant lead that what we've seen in value has not yet been able to overtake that type of run. So with that type of backdrop, and also knowing that the fixed income markets have posed their challenges as well, Beth, I'd like to ask you, can you talk a little bit about how we've done within some of our multi-asset class strategies first?
Yeah, sure. You can see here our multi-asset class accounts, they've marginally outperformed, in a very tough market where, like you mentioned, it's been tough from an equity perspective and also a bond perspective. We did intentionally lower our exposure to equities, our allocation there. That's been the right thing to do. That's really helped to offset some of the negatives that we've seen on the bond side, but then also on the equity side, a couple of key factors that have been challenging for us in this short-term period so far this year. The first is, the greater tilt to growth that we have in our portfolio, where growth has lagged the broader market, by quite a bit. And our growth tends to be focused on, very high quality companies that are well positioned from a long-term perspective. We're typically, not investing in a lot of, very high growth, unprofitable, companies. But just overall growth has taken it on the chin. And then the other factor has been our underweight to the energy sector. That's been the best performing sector of the market. We were extremely overweight energy in 2020 and in 2021, and had that having, kind of run its course. And I'll talk a little bit more about why we've exited the energy sector, but that has been a drag, this year so far. Actually over the past month or so, that has really started to alleviate. Oil's back down to, I don't know where it is at the moment, but $100 a barrel, and it was as high as 120. So we're starting to see that, that alleviate. I think we'd like to be outperforming by more over the shorter time frame, but I do think from a longer term perspective, we're still well positioned.
And distilling that down to some of our all equity strategies specifically, many of the same themes coming out of that research engine we're seeing within our U.S., non-U.S., and global strategies.
Yeah, absolutely. We have, same growth tilt in these portfolios that are the all equity, sort of sides, and the underweight to energy there as well. One I just wanted to highlight is our core non-U.S. strategy. We have really been impacted by a fair amount of idiosyncratic kind of company specific drivers of that underperformance there. And that has been additionally challenging for that portfolio, over this short-term period. I just want to highlight this, most of that is being driven by a few stocks that have been multi-year outperformers for the portfolio. They've been more in the crosshairs of the growth, tech rotation that we've been seeing. But generally these are companies that we still see as very attractive long-term winners. And some of them we've been just starting to dip our toes into, maybe adding a little bit here and there. Generally, we're still pretty cautious, but you may start to see more of that, type of behavior from us in terms of adding to some of our highest quality companies as they get more attractive from a valuation perspective.
And then regarding two of our specialized strategies that we tend to get a lot of questions about, our disciplined value and our international small cap strategy. Starting first with international small cap, given that it has also been exposed to many of those same themes, Beth, that you just discussed. Its names tend to have a bias towards growth. They tend to be dominant companies within their industries, or in some cases, even global companies. Although small, their niches have global reach, and they can at times be fast growing. Given that growth has been so out of favor thus far this year, there has been a bit of a baby thrown out with the bathwater situation regarding that strategy. Although we do remain very confident in the particular names and the direction of the strategy in general. And then regarding disciplined value, the strategy itself has certainly benefited from the stylistic shift from growth towards value. But within DV specifically, in the nature of the way that strategy functions, it has a particular focus on companies that pay dividends, sustainable, growing dividends, that have strong cash flows, that have healthy balance sheets. These aren't just value in the sense of value junk sometimes types of names. They are quality businesses that oftentimes are just a bit cheaper than the broader market. Given the economic uncertainty out there, to us, it is no surprise that those types of quality businesses have benefited from what has been in favor for investors, at least thus far this year, and to be determined going forward. All right, so with that, now it's time to get to what we call your questions answered. And in this case, Beth, Managing Director of the Capital Goods Group, we're going to ask you a couple of questions, and we received a number of these beforehand. So thank you to all of you who pre-submitted questions ahead of time. We grabbed some of those that we thought would be most broadly applicable to the audience. And so we've got a smattering of topics that I certainly am interested in hearing your views upon. So let's start with the one you mentioned earlier, and that being gold. And the question is inflation causing us to look at gold?
Yep, we actually do own a group of gold miners in the portfolio. That's our preferred way of getting exposure to gold through equities in our portfolios. Historically, gold has acted as a safe haven in economic downturns. You can see here on this chart the relative performance of gold during periods of pretty significant downturns in the market, and that's no surprise, that's when gold really shines. We're seeing that year to date as well. We have actually increased some of our exposure to gold earlier this year through the gold mining companies. We think it plays a unique role in asset allocation, and so favorable on owning that here.
And specifically, how are we going about doing that in our strategies?
We, like I mentioned, we own a group of the gold miner equities, and so those are sort of our the way that we invest. We have 3 strategies. We have every equity that we buy has to fit one of those strategies, and so that's we utilize our strategies to invest in the equities versus the actual commodity
Yep.
in the portfolios.
Yep.
So.
All right. So let's talk about commodities and let's talk about oil, because we know we get this question quite regularly out there. We had owned oil quite a long time ago, a couple of years ago, when we saw the opportunity present itself. But as conditions change, as they've evolved, our positions on that have evolved. So can you take us through not just where we stand today, but the whole story on our view on oil?
Sure. Yeah, I'm happy to. It's probably a really good walkthrough and a good example of how we invest in commodities, in general, utilizing a sort of strictly defined strategy that's very, very much focused on supply and demand. And when we see significant dislocation in supply and demand, so very loose supply and demand situation, that's the time you're typically seeing us starting to build and buy positions. And the reason for that is, companies are effectively their returns are shot. They're typically losing money. It's times when industry pain is very high because the supply is too much for the amount of demand that is in play. That was certainly the case for oil in 2020. Coming off of COVID, I mean, something we've honestly never seen before. The decline in demand that we saw was just enormous. But we knew that that as we recovered from the pandemic, that demand would eventually return. And so it's during that time when industry pain is just really high and bankruptcies are happening, industries going under consolidation, companies are combining. That is basically what is driving the ability for supply and demand to tighten, because the companies can't afford to be in business anymore, so they're shutting their doors, they're shutting down capacity, and that is what begins to allow for the tightening to occur. At the same time, we also had demand recovering, and that just allowed for this several quarter period of tightening, and that's what led to the recovery in oil prices. And so we held on, we built a pretty significant overweight to energy at the end of 2020, held it through most of 2021. As we started this year, basically the opposite conditions were in play. So the market was very tight. Supply and demand was very, very tight. Oil prices were at very high levels. And then we had the war breakout, and that just sent things, even higher, from there. And what happens typically in commodity industries is when returns become really attractive and companies are generating a lot of cash, that attracts more capital to the industry. More capital means more, capacity, more supply, and that really is what sows the seeds or brings about the next downturn, and brings about the loosening of supply and demand. And so that's a little bit just about how, I know it's kind of long-winded, answer, but that's a little bit about how we invest in commodities. And what we want to highlight today, and why we got out of energy when everyone is getting back into it, it seems, is we just want to highlight how very cyclical commodities are, and specifically oil in this case. This chart is just showing what happened to the price of oil in the great financial crisis. In a matter of 6 months, the price of oil fell from $145 a barrel to $40 a barrel. It is extremely cyclical, and we don't think that is something that has changed. And when we're looking at the odds of a recession, having risen significantly, our house view calling for a major economic slowdown, we felt it was very much the right thing to do. Timing this is very difficult. Timing the exit You'll never hit the top perfectly. You'll never hit the bottom perfectly. We tend to be early when we're looking at very cyclical commodity markets. We tend to get out of them before they peak. And that's in an attempt to protect the gains that we have generated, during the upcycle, and provide that downside protection in a very cyclical, part of the market.
And I want to go back to that exact point because we see this a lot. And in many ways, this is sort of anecdotal, but it feels like a lot of the same people who are out there saying, hey, are we already in a recession? We're going into a really deep recession, are often the same people who are saying, well, I want to be loaded up on energy. But those are in many ways kind of incongruous thoughts.
Yeah, absolutely. I mean, it is, it does feel contrarian to be out of oil, but when you look at what it typically does in a recessionary environment, it's strange to me that we're not seeing that. I mean, we are starting to see it over the past, month or so, where we've seen the performance, start to deteriorate quite a bit. So yeah.
All right. And so another one that you brought up, and this is the next topic we do want to get to, that being the war. And it has certainly made an impact on energy markets. There is no doubt about it. But we have also made some portfolio changes that, while not a direct result of the war, I guess are sort of related.
Sure. Yep. Yeah. I'll talk a little bit about the exposure we have to defense companies. We do have a group of them that we have bought and added to this year. We were actually working on these companies as an idea for the portfolios prior to the war breaking out, because the fact that, defense companies, they have a really long track record of strong, absolute and relative returns. Defense is defensive in a portfolio. They are particularly attractive in recessions because they're not correlated really much with the economic cycle. It's really defense spending that is what drives the defense stocks. They're also really attractive to have in an inflationary environment. They're pretty much immune to inflation. They pass the costs that they incur right onto the government. And so they were looking really attractive to us prior to the war. And we had sort of this view that geopolitical tensions were, rising, and that would be supportive for defense budgets. And then the war, the war began, and we decided to go ahead and add, these to the portfolio, despite the fact that valuations on them had begun moving up. And the reason for that is that we see a longer term, very supportive environment for global defense budgets here, and that, like I mentioned, is the main thing, that moves these stocks. When you look at Europe, they've been really behind in terms of spending on defense. They've been pretty complacent. We've been in pretty peaceful times outside the Middle East for a long time, and they really haven't been keeping up. NATO targets 2% of GDP. To be spent on defense, and many of the the countries in Europe, have been underspending for years, and they are now starting to step up and commit to higher levels of spending. We think that that's going to be really supportive for them. In terms of our actual exposure, we have a group of prime defense contractors that are pure plays on defense, and they are companies that are best positioned for where the defense budget is growing the fastest. So that's areas like space, cyber, hypersonic missiles, electronic warfare. We have a photo here of Tom Cruise in the new Top Gun movie. And if you have seen the new Top Gun movie, then you'll see that electronic warfare on full display. Probably the closest thing I'll ever get to, being inside of a modern fighter, jet. It's really pretty cool, the technology. And the way warfare is conducted today. So that's the little bit of research I like to do on the weekends. So.
All right. So one more question here, and we're going to shift gears from Top Gun specifically to maybe another area that might still be a little bit near and dear to your heart. And if you could put on your old hat and talk a little bit about what we're seeing in the real estate market. I know a lot of listeners are seeing either their own houses or their neighbors. There's a lot going on in the housing market specifically, but can you add any color to what's going on with real estate prices post-pandemic?
Sure. Yeah, absolutely. Touching on specifically the housing, residential housing, part of the real estate space, we have definitely seen, very strong price appreciation there, and that's driven by demand. We have a very strong demographic tailwind supporting, demand for housing, and that has not let up. And so, that's one of the big factors that's been driving, that appreciation there. We aren't doing much with housing now because of the fact that, that things are pretty overheated, in our view. But we are getting ready, typically housing, even though that we see those sort of longer term secular supports to it, it's going to be sensitive to a recession. So there's some real high quality companies actually that we have, something like a Sherwin-Williams is a good example, where it's a good beneficiary of the housing market and something we want to own, but it's a good example of something we're being patient on, waiting for the sort of turn in the housing market. And the real estate space is not, I think we think of, residential housing because we all, many of us own a home and that's our closest tie to real estate. But, when we take a step back and look at overall, commercial real estate as well, we think it's a really attractive time for it. I spent a decade working on real estate. It really wasn't the greatest environment because when real estate really shines is in inflationary times, and we haven't had that for some time. And the reason for that is leases and rent streams are tied to inflation benchmarks like a CPI type of benchmark. And so there's escalators that are automatically built right into the leases that cover inflation. And so the sector tends to be a pretty good inflation hedge. It is pretty nuanced. There's areas that we avoid, something like downtown office. We haven't seen a recovery in the vacancies there. I think hybrid work is a big question mark. How is that part of the market going to, it hasn't been permanently changed. Are we in a place where we have a, permanent, lower need for, downtown office space? On the flip side, something like single family rental housing is an area of the market that is really strong. It's in a sweet spot, we think, given the amount of home price appreciation we've seen, rising rates, a lack of inventory, all of this is really supportive for, that. So just two, kind of different, I mean, there's lots of areas of the sector that you can, look at. But overall, yeah, it's an area we have a decent amount of exposure to.
Yeah, and I think that's the main point, is it is such a broad and varied sector. And sometimes, at least I think about just real estate in general, but the business dynamics that could underpin something like data center REITs or cell tower REITs are completely different than, downtown gateway office building type REITs. And for those reasons, that's why it makes sense to have a dedicated strategy to dive into exactly those nuances.
Yeah, absolutely.
All right, well, that brings us to the end of our prepared remarks. We're going to leave the last few minutes open for Q&A. And as a reminder, please feel free to submit any questions that you have during the Q&A portion of the event. And we do have a few that we also got ahead of time. And again, thank you all for doing so. One of which, and this is long, so I'm not going to read it word for word, but this particular listener was interested to hear your thoughts, Beth, on some of the clean energy trends that are certainly topical right now, especially after the war.
Yeah, sure. We've spent time in our group, working on various areas of sort of the clean energy space. It's very broad. There's a lot there. So it's an area we've spent time on. We think that there's, good secular sort of longer term growth, there. And I think the energy crisis that we're seeing is supportive of, the need for, alternatives. It's a tough area for us to invest in, given the amount of reliance that it has on regulatory support, which can be difficult to predict and can, that stroke of the pen risk can be tough, for us. But when commodity prices are as high, as they are, alternative energy, electric vehicles, these alternatives, they become a lot more attractive. And this has kind of always been our view that the way that the space actually would be able to succeed would be on the heels of much higher commodity prices. When you take a look at something like electric vehicles, certainly we've seen consumers historically switch from like gas guzzlers like SUVs and trucks to sedans and more efficient vehicles in times of oil prices. Electric vehicles are still more expensive, than an internal combustion engine, traditional vehicle. But the lower cost of powering them, may help to increase demand. And demand has been really growing strong, for electric vehicles. But I think it's interesting to just point out, with all that we see and all the headlines that we see on electric vehicles, it really only make up about 2% or so of the total, global vehicle fleet. So growing fast, but still, pretty small in the grand scheme of things.
All right. And we have another question here from a listener asking for, and again, we have a lot of financial professionals on this call, tips for building portfolios today for their clients. Beth, if I could jump in and grab this, a couple of thoughts come to mind as I read this over and think about it. And I know we spent a lot of this call discussing our traditional bottom-up strategies and the multi-asset class ones specifically. But if you're looking for some more unique ideas, I'll point you to two. One of which we had discussed before being the international small cap strategy, an often overlooked area, one that is certainly, as we said before, dealt with the baby being thrown out with the bathwater thus far this year. But the merits of that strategy remain as impactful as they have ever been. That being that it is an overlooked space with growing businesses and a lot of opportunity for long-term investors, and especially those who have a strategy that's specifically dedicated towards capitalizing on those particular types of opportunities. And one other one, and I know we had just discussed this about a month ago with many of you, if you sat in on the call with Mark Bushalo, our managing director of fixed income, and he specifically pointed to the importance of, as we head towards an increasingly uncertain economic environment, those economic fundamentals and that uncertainty will have an impact on financial markets and the bond market specifically. And in this case, that could be duration, rates, that could be credit and spreads. Having a strategy built into client portfolios that is flexible and adaptable, that can be nimble and quick, that can act in an unconstrained manner, can add a lot of value as things get more uncertain, which, as we discussed at length during this call, is our outlook going forward, at least through the rest of this year in the intermediate term. So hopefully that gives you a few ideas. I know that we had shared into the chat some different ways to reach out. So if any of those spark interest, certainly feel free to click the link in the chat and reach out, and we're more than happy to get you in touch with a consultant who can help. All right, and so I'm gonna kind of stuff two of these together here, Beth, one of which is asking about a soft recession specifically, and another one here asking about whether we are going to, and I know we sort of touched on this specifically, but it probably is worth asking directly, are we going to get a recession this year or next?
Yep, sure. This year or next, I mean, it's a great question. Essentially, no one can answer right now. And it's kind of $64,000 question. I think the answer in hindsight will be dependent on the Fed's actions, the timing of those actions, and how the economy ultimately reacts to those actions. So there's a lot of scenarios. There's a scenario where, Fed hikes sharply to get inflation down. It tips us into a recession. That could happen this year. There's also a scenario where they take a more measured pace, but ultimately the slowdown that's caused by higher rates still tips us, into a recession. But perhaps it takes us longer to get there, maybe not until next year. There is the possibility that the Fed successfully sort of threads the needle here, and we get a soft landing where they take a more cautious approach, where we see the yield curve, start to flatten and the pressure on both equities and bonds is alleviated. This is probably one of the lesser, likely outcomes in our view, because it's very hard for the Fed to get the timing and the magnitude of rate hikes perfectly. But it is possible. We think that inflation is going to be the top priority for the Fed, likely at the expense of economic growth. And then there's also the question of how deep of a recession we might get, and the question of the length of the recession, deep and short, long and drawn out. We do think it's more likely we're moving into a more sustained period of slow growth, and that the Fed will likely not respond to a recession by sharply reversing their course on rates. But these are all just possibilities. We won't really know until we're there. And it all depends on the actions of the Fed and the ability of the economy to withstand them. So for now, we're remaining focused on quality in the portfolios, using things like cash and gold where we can, like I mentioned, preparing for better buying opportunities. And then in terms of the question of, whether or not we're sort of already in a soft recession, certainly you're seeing that thrown around a lot when it comes to Europe. And so I think they're sort of further down this path already. I think it's a very valid point, that we may very well be looking back. A lot of times you don't know these things until you're actually through them, when you can start to look back and say, well, that was the beginning, of it. So a good question, on that. And then,
Well, if I could jump in for a minute too, part of the importance of having disciplined, time-tested processes is to be able to deal with the fact that, we are all human. There's an emotional component to investing, but having disciplined processes that you just discussed to be able to fall back on and say, is this meeting our pricing disciplines? Does this actually fit the strategies, or are we getting caught up in perhaps a bull market or perhaps an excitement for an investment opportunity that maybe doesn't make as much sense? All right. And so with that, thank you. Unfortunately, that is all we have time for today. If we did not get to your question, and I know I do see a few of those out there, we will be sure to follow up with you after the presentation. And as a reminder, for your convenience, a recording of this webinar will be emailed to you shortly afterwards. We also have a survey in the chat. We encourage you all to take a look, click on the survey, and let us know how we did today, and provide any feedback, because the feedback you all provide us both before the webinar with those pre-submitted questions, as well as in the surveys afterwards, help us steer this event to make it as impactful for you each and every quarter. So with that, Beth, thank you for being here today.
Yeah, absolutely. It was my pleasure.
And to our listeners, thank you for attending today's webinar.